Hi all, this is Akshara Menon from PMS Bazaar, welcoming you to another Fund Manager interview series. With me today we have Mr. Ashish Chaturmohta, who is the Managing Director, Apex PMS Strategy from JM Financials Limited. He is a qualified chartered accountant with over 16 years of experience in this capital markets. So just have two lines about him. He is a seasoned investment professional known for his deep analytical acumen and market foresight. His investment philosophy is rooted in the fusion investing framework, which is an FTM, which stands for fundamentals, technical analysis, psychology, and market dynamics. A holistic approach that blends science and art of investing. Hello, sir. Welcome to the show.
Thank you.
So let's start out with a very simple question. What is investing mean to today's investors? Like a lot of investors who are new to the market after this 2020. So for them, they haven't seen much of market drawdown. So what does investing mean to them?
Definitely. So see, I've been in this market for more than 18 years, seen different cycle. And one thing which I can confidently tell you is that, new investors, yes, from a return perspective, they might be chasing some higher returns or looking for higher returns because that is what they have seen since 2020. But one thing which I can tell very, very confidently is the new investors are also very information oriented. They are having access to so much data that when I meet and go and in a tier 2 or a tier 3 cities, I can see that change which has started coming. They want to know why. They want to understand the business models. They want to understand why this sector is doing so well. And that's the rationale and that's the reason behind which they want to invest, which was not the case in 2006, 7, 8 or when the 2008 drop came. And that's the reason when you today look into the DII's data, it's almost $73 billion which they have poured in the year 2025, despite the fact 2025 has not delivered positive return. There's a lot of variability in returns with different funds, different PMSs or different mutual fund schemes. But despite that, there's a lot of interest which is emerging. Second, I can see that now they're not just chasing the large caps. There's a lot of interest towards emerging concepts or emerging stories. They are ready to invest in concept kind of thing also, where you might not find immediate, a top line or profit growth or EBITDA, but still the understanding is increasing, and that's where that confidence is coming to invest in a concept to stop. So I can say very confidently that today's investor is far more matured as what we used to see in 2006, 2007, 2008.
So convincing today's investor is a bit easier when compared to the investor like previous generation.
You can say it's both, because to make them convince on a particular sector and theme, then you need to be really very well prepared. That's a good part of it. Second, because they are doing too much of studies on themselves, but the only part which is missing is they've not seen the cycles. So sometimes the quality of the business, corporate governance, these are the things which many a time we see that they might miss on these aspects. This comes with experience. And that's the only concern which I have, because when you do concept investing, when you just look into certain theme which has got some serious tailwind, you might end up buying into those stocks. But ultimately we have to understand businesses are run basis the management, and if the management or the corporate governance is not great, then even the businesses can be good, but it's not. But it is important for a particular company where you are investing, the promoter ethics should be of high regard, and that's where I think a lot of work need to be done. with new set of investors.
Which said that actually, when you mentioned that you have 18 years of experience in the industry, of course, so you've seen a lot of up and down,
Yes.
bad and all, everything together. So in terms of markets, what has changed? Like it was like 18 years ago, this was the market, and now this is the market. So how do you see the change now?
So 18 years back, I think it was more of tip-based investing. A lot of people used to just want to get into quick buying, and they want to sell it quickly so that they can make some quick returns. But that's not the case now. People are chasing stocks which can do really well over next 3 or 5 year period. They are trying to identify companies which can compound at 25%, 30% compounded, because the sector or the space is doing so well. And I think, in fact, you guys have done a phenomenal job. In fact, a lot of companies who have started giving education, giving information on website which is freely available, they are trying to get access to those kind of data, and that's what they can confidently come and ask that, okay, what is the tailwind? Where the margin is going to come, while the top line is going to grow, whether the debt levels are going to be manageable. All these kind of smart questions are being asked today, which was not the case a couple of years back. So I think that's a very, very big change which has started happening.
As you're talking about this DII and FII, of late there's a culture of DII buying more and FII selling. So how do you see the sentiment?
No, so definitely, if you look at just the data point of October, FIs have sold, have bought almost $2 billion. But if you look at the calendar year to date, they've sold almost $15 billion. But what have DIs have been doing? So DIs were buyers in the month of October to the tune of almost $5 billion. And if you look at calendar year to date, they've been buyers to the tune of almost $73 billion. So it is kind of offsetting all the kind of selling pressure which we are witnessing due to FIs. And this is not a trend of last 12 months. This is a trend for last 3 years. You see where FI holding has come. FI holding is below 16%. So it has already come down by good 6-7% from their regular or normal holdings. There's a reason to it. We are seeing the Fed rates going up. You have a currency risk. So all put together, if you look at the expected return for FIs, they needed some extra returns, and this was not the case. So this is the reason we saw some serious selling coming from FI. But because DIs or retail participation or equity culture has increased so well, that it kind of offsetted all kind of selling pressure which got witnessed due to this FI selling. And we believe that this trend is going to continue. The retail participation is going to increase. They have seen 1 year which was kind of a flat return, but we have not seen any kind of reduction in the the SIF inflows. And the good part is, in the month of October, for the first time, we have seen some buying interest coming from FIs. But can we say that it is a structural trend, or it's more of a short term kind of correction to the trend which was there for last 12 months? My sense is it's a first sign that because of the kind of policy push, the kind of earning growth momentum which we have witnessed in the first half, and second half is expected to be far better, maybe in days to come we might see FI buying interest also coming back to Indian markets.
So when you say DI, are more by buying terms, do you think our Indian markets is less correlated with the other markets, or it's more correlated?
No, so if you see last 1 year data, clearly Indian markets have underperformed global markets, and the underperformance was not small. If you look at MSCI world market, it has delivered almost 20% kind of return. If you look at MSCI emerging market, the returns were to the tune of 30%. If you look at MSCI China, it has delivered 33% return. Now, what were the returns of Indian market? Indian market delivered just 6% kind of returns on BSE 500. And if you look at the small cap, it has delivered a negative return, which means the kind of outperformance Indian markets showed with other markets in the last many years, actually it saw some serious profit booking. And China, which was clearly underperforming for so many years, has started showing a lot of interest. So my sense is, obviously from a valuation perspective, we reached almost 22 times forward PE multiple. If you look at our gap with the emerging market in terms of valuation. We are trading at a significant premium. So that premium has come down. So I can say now we are in a comfortable position, not just basis the valuation, but because the kind of this premium, it has seen a correction and we are in a comfortable position. So my sense is there will be a lot of buying interest which can come from FIs, and anyways DII's participation is increasing.
Market.
Mutual fund as a percentage of GDP is below 20% in India, but globally, USA it is 150%, UK it is 80%. So I think there is a lot of scope for us to grow, and that's the reason we believe that the overall industry is going to see a lot of growth. Mutual fund industry is going to see a lot of growth. PMS industry is growing at a 20% CAGR. So my sense is yes, a lot of participation and liquidity is going to chase Indian markets. Only I would say my caveat is there will be a lot of sector rotation. You can't be just betting on one sector and say that it is going to do well. There's going to be a lot of sector rotation because we are at a higher end of valuation, and that's the reason there will be continuous profit booking in extremely high valued sectors and shift towards reasonably valued sectors.
Okay. When you say that, actually, like 3-4 years before, you see manufacturing sector was, every fund manager was crowding
Yes.
over it. And now if you see on the consumption side, that are overcrowded here. So how do you see this difference? And do you see any undervalued sectors where fund managers are not looking into now?
See, honestly speaking, manufacturing is a long-term theme, and the tailwinds are really strong. If you look at, manufacturing as a percentage of GDP, it is still 14-15%, and there's a lot of scope for manufacturing as a percentage of GDP to go up. But the point is, market also rewards growth. So the point is, yes, there's a lot of scope for growth for manufacturing as a sector. But the point is, most of these stocks reached to an exorbitant valuation in the last 3-4 year rally. And then came the election. When the election outcome came, lot of this valuation started seeing softness because the earning growth started tapering. Budgetary allocation started reducing for a lot of these sectors. Maybe you can see railways, there was no incremental allocation, but for defense there was a reasonably good allocation. So now it will be more sector specific approach within I think the capital the capex or the manufacturing sector. But you can't say that within the manufacturing all the companies or all the sectors are going to do well. For example, within power, so within power generation, transformation is a very a big theme, because that's where I think the compounding cycle can continue for a very long time. Or maybe battery storage could be a good theme. So those kind of selective themes within power can do well, but not necessary that within power the renewables are going to do good, or maybe wind is going to do good. So we have to be very, very selective. That's the understanding which I have at this point of time.
So it's better to have a bottom-up approach.
Yes.
So not necessarily everything under one sector would work well.
You have seen this in defense. See what is happening in defense. A lot of companies where the order book is consistently going up. Maybe some electronics company within the defense basket. There we are seeing renewed buying interest coming from the investors, from the institutional investors. But there are certain pockets of defense which is not seeing the interest because the order inflow momentum has come down, and it will take a lot of time for them to execute these orders. So you can't be paying 40-50 PE multiple for companies which are just going to grow at 10, 12, 13%. What you really need is if you're paying a 40 PE, then ideally at least the company should grow at 25%. Or if the top line is growing at 20-25%, the profit growth should be far better than the top line growth. Then markets will still reward those companies. But companies where the multiples are expensive and the growth is subpar, then I think that's where the market is going to punish those companies, even if the sector is very sunrise sector.
So if I could ask this, is there any sector currently you feel that a fund manager is not looking into, but JM is into that sector?
So I'll say one subsector like banking. Everyone is bullish about banking because of the valuation comfort. We know private banks are trading at 2.1 time price to book on a forward basis. Credit growth is moderated but expected to grow up because the liquidity or the CRR has been reduced, your repo rate has been reduced. So the credit growth environment is going to improve. But a lot of people missed on the PSU banking as a theme. So we're overweight on PSU banks as a theme for last 1.5 years. We believe that the valuation comfort was very good in PSU banks. Most of the PSU banks are today trading below 1 time price to book. But look at the credit growth. They've been growing at 13 to 14% in terms of credit growth. Look at the operational performance of these PSU banks versus private peers.
banks.
It is almost in line. But where's the valuation? Valuation is a significant discount. So I think there's a re-rating which is happening in PSU banks. A lot of banks posted their numbers, and they in this challenging environment, the credit growth was almost 13 to 14%. NIMs are in a comfortable position, and the credit quality and slippage ratios are in a comfortable position. So all put together, I think there is a re-rating which is going to happen in PSU bank, but the weight of PSU bank in the overall banking index is less than 20%. So a lot of fund managers try to be underweight on PSU bank and overweight on private sector. But see what has happened in the last 3 months, 6 month period. If you'll see the outperformance of PSU banks versus private peers has been very good, and that's where I think as a fund manager, maybe we don't want to just get into some sector which is completely avoidable, but within a large sector, there is a subsector which has the possibility of showing better performance.
Yeah, which said that, is there any sector that you're currently avoiding?
So, you will see very less or maybe complete underweight of our positions into IT as a space. Okay. So we believe that, it's a big weight in the index, almost 14-15% kind of weight at an index level. But we are not comfortable with the current situation where the discretionary IT spending is completely missing, where the constant currency growth is missing, but the valuations are at reasonably higher level. And what we believe is most of these large cap IT companies, they have kind of missed the bus of AI, cloud, ML, and that's where our focus on the IT companies, if it has to be, would be on some small and mid cap companies which are trying to be very niche in the segment of new age IT companies. And that's the reason if you look in our portfolio, we are very, very underweight on the overall IT as a sector.
Okay. So do you think this current situation, a few years ago, people were giving more allocation to ITs. Now, again, the allocation has been reduced a bit now. So do you think the situation would continue further? Because that doesn't depend only on the Indian markets. Of course, the global market is also interlinked with this IT department. So I just want to understand that part.
So, Akshay, I would like to say that where's the growth coming? If you look at globally, the IMF came out with a outlook where they downgraded growth GDP outlook for the entire world except India, where they said that the growth outlook is they're revising to 6.6 from 6.4, which means the overall growth is going to come from the fastest growing economy is going to be India. And within India, where the growth is coming, it is on the domestic front, not on the export oriented front. Second part is if you look at the export numbers, they've started coming down. So there are a lot of challenges because of the currency risk, because of the kind of demand which is collapsing. So my sense is one need to focus more on the domestic themes at this point of time and kind of avoid a lot of these export oriented themes except import substitution theme or something like CDMO or CRDMO, which is a great opportunity to play because there is a kind of substitution which is happening. In US, the cost of R&D is going up. Margins are shrinking. With the new US Biosecure Act, lot of supply chain diversification will start happening. So there could be a big alternative to China, which could be India. And a lot of Indian CRDMO players, they have become efficient in terms of cost, in terms of regulatory compliances. They are transitioning from being a pure API player to a decent CRDMO player. And that's where I think the size of opportunity lies. So within export, if we have to bet, we would like to bet on themes like CRDMO rather than saying that we are bullish on the entire export opportunities.
Got it. And as a PMS an industry, let's talk about the PMS as an industry. It has grown quite a lot, and today we are at 8 lakh crore plus in terms of AUM. So do you still feel that PMS as an industry is only for the niche clients, or it is more turning into a necessity and not a choice anymore?
No. So as you will see the participation increasing and the further allocation from investors, you will see a lot of renewed interest which will come to PMS. Why PMS? The reason is very simple. You will see that this is a niche product where you can do a lot of concentration, where you can say that, okay, you are positive on certain themes. So you don't need to end up buying the entire sectors or different stocks from different sectors. You can focus on just 3, 4, 5 good themes and try to construct your portfolio around those themes, which are high growth themes. So I think now what is going to happen within the PMS is the product proliferation is going to come down, and focus would be on alpha generation, focus would be on risk management, focus would be on transparency in terms of education, in terms of awareness that why this particular theme or sectors or companies are being bought. So those kind of transparency, if you bring on table, I think there will be a lot of buying interest which will emerge in the PMS as a product. Second, I think there will be subset within the PMS which will get created. So there could be thematic themes which can start coming into. There could be factor based investing themes which will start emerging. There could be rule based products which can start emerging, and that's why a lot of people are now talking even about technical products coming into PMSs, because this is more rule based. So I think there is a lot of scope. As you are aware, in our product also we do a combination of fundamentals, technicals, market dynamics, psychology. So I think it's a good kind of style where we try to give weightage to all different aspects of the market.
That's very true. And let me ask you this one more question on it. The gold has rallied a lot, and that is always the talk of the town. And again, there's a dip again. So as an investor sentiment, investors bullish on a bit of gold. They are going to buy gold and they want to invest in gold as such. So for the investor of that kind, what would your talk would be to them?
No, so definitely, even from our portfolio perspective, we had some allocation to precious metals in the form of gold and silver. The reason is, if you look at the long-term history of gold, it has compounded at good 11.5-12% for last many years. So it kind of creates a good hedge in your portfolio against inflation, against geopolitical uncertainty. And in an environment where you had seen Russia, Ukraine, China, US-China issues, India facing a lot of issues with other countries. So all this, a lot of central banks have started accumulating gold. So this is a very long-term cycle which is supportive for precious metals. Yes, gold has seen a phenomenal rally. We have seen almost 52% rally in gold in the last 1 year, and to add it, silver has given 68% rally in the last 1 year, which has underperformed for last 18-20 years. So maybe after this strong outperformance, there will be periods of profit booking, there will be periods of consolidation, but according to me, the long-term trend for a lot of these precious metals is positive. And as a tactical allocation, one should have a reasonable allocation towards this precious commodity.
I think we should thank our grandmothers, because gold was in existence even before equities.
Yes.
So I think our previous ancestors should be thanked for this. So moving on to the next, let's have a quick rapid fire round. But before rapid fire, let me talk about your strategy. Apex as a PMS has given over 20% CAGR. It's in its inception. So it's quite a good number with this market moving bear and bull each and every time. So what does that contribute to this CAGR?
No, so definitely I will call this strategy as a very active fund management strategy, because on day one, I've been tracking markets for so many years and realized this: there is no one short way to make returns in the market. There are times when you will say that I should be investing only in Nifty 50 companies. There will be times you will say, why am I investing in Nifty 50? I should have been into the small and mid cap, which has given more than 25% CAGR return. But then the day come 2018, when the small mid caps corrected more than 40% and your Nifty or large cap index were flat, and investors were so worried that what has happened? How come portfolios down 40% when markets are flat? So I think the portfolio has to be a balance of large cap, mid cap, small cap, micro cap, everything. But there has to be a reasonable balance within the portfolio. Second part, which is more crucial, is the active management part. Because I'll give you some data point. 2014, the pharma sector peaked out.
Yes.
And it took almost 7-8 years for pharma sector to reach back to the same level. Does it mean markets didn't deliver any return in the period? Market gave a very positive return, but a large sector actually underperformed to a great extent. What happened to auto as a sector? The largest automobile company, Maruti, corrected good 40-45% from the peak. During the time when the markets were going up, PSU banks, which we give at the data, it peaked out in 2011-12, and it took 11 to 12 years for PSU bank to reach to the same level. But during the same period, ICICI Bank continued to deliver return almost more than 18-20% kind of CAGR return. Same was the case with HDFC Bank. So I think what we need is an active management. We need to do a sector rotation. We have to be in market. We can't be out of market. But within market, active sector rotation needs to be done, and that's where our strength lies. We are firm believer that the foundation of the portfolio should be based on fundamental, but the timing, the weightage, and the churn should depend on how the technicals are looking, how the market psychology is panning out, how the dynamics of the markets are changing. Just to give you a perspective on market dynamics, defense as a sector, 2014 Modi government came into power, and they've been talking about a lot of reforms being done into defense. But from 2014 till 2019, how many fund managers used to have a good allocation to defense? Hardly any. But from 2020-21, and particularly post Russia-Ukraine war, this theme got a real sense, and people started realizing the importance of make in India, self-reliant, indigenization, and this kind of created a re-rating into the stock. So the stocks which used to trade at 12, 13, 14 PE multiple, they went to a PE multiple of 40, 50 times, and the earning growth also went up strongly. So my point is, it is all about sector rotation. But if you don't keep a pace with sector rotation, then there is a probability you might get stuck at a higher valuation basis that in the last 5 years it has delivered good returns, so I'll continue to hold this stock for next 2-3 years. You might see that those stocks might see a bigger correction also. So what we need is an active management and a continuous rotation within the portfolio.
Of course, but said that, and with active management, what happens is that churn.
Yes.
Then when you're going to have a allocation in large cap, mid cap, and small cap, and again in a bit of precious metals also. So how do you churn? How do you look at the churn of this portfolio?
Yes. So what we have decided within the portfolios, there has to be a good balance between buy and hold and a tactical opportunity. So typically 50 to 60% of our portfolio is buy and hold.
Okay.
And you can say 40 to 50% depending on the market dynamics. If the market dynamics are indicating that the churn will really help us to generate better return, the churn can go to 50%. But if tomorrow, if let's say markets are the way they are right now, and it's more of a consolidation which is taking place, there's no serious buying interest which is emerging, so there's no point of doing too much of churn. So in these kind of period, automatically the churn will come down. So churn is a function of how your alpha generation is taking place and how the risk management or cutting your losses is happening. Because in our market, what is important is to ride the winners, but to cut your losers at a reasonably right time. And that's our endeavor. We try to book our losses early, but try to ride our winners as much as we can.
I think that's an art, when you cut your losers early. I think that becomes an art in PMS.
Yes.
That's very true. And if an investor is coming today to to you and asking you to go for his investing part of it, so how does his portfolio look like?
So currently, if you look at our portfolio, has got almost 55% weight in the large cap space, maybe 20% into the mid cap space, and the balance into small and mid cap. So small and mid cap, the variation which we try to keep is anywhere between 25 to 35% kind of range. We try to maintain large cap or NSE 200 bare minimum at 50%. So it can vary between 50 to 60% depending on the market. Current situation, it clearly indicates that large caps are better placed from a valuation perspective, from a earnings visibility perspective, from and if FII's interest starts to come back, then I think again it will be very supportive for the large cap. So keeping this in mind, and banks, as I mentioned, the valuation comfort of banks are in a very comfortable zone, and banks constitute almost 33% of the index weight. So keeping this in mind, I think large caps at this point of time, we are little overweight in our portfolios.
And there's no in cash, nothing in cash.
Hardly. We are not a firm believer of keeping too much of cash. Maybe for just because we have booked something and we want to enter, there could be some cash, but we generally avoid taking too much of cash, except for a situation like COVID, or if India-Pakistan war kind of situation when it arose. So maybe at that time we would like to keep some cash, but our style of managing the risk is different. First, it's sector rotation, and second, by buying nifty puts. Hedging is very important in our portfolio. We try to hedge our portfolios by buying nifty puts so that the drawdown drawdown could be minimized.
So let's jump into the rapid fire part of it. So first question is that if you had to share a coffee table with someone in this industry, who would that be?
So honestly, there are many names, but Peter Lynch is one guy whom I've been reading his books. I've been following his style of investing. To some extent, I could say that I'm a growth investor rather than a value investor. So to that extent, Peter Lynch would be one.
Of course you are, because as the interview went, we're more into growth perspective.
Yes.
So the second rapid fire would be like, if you were not a fund manager today, so what would have been your profession?
So, after completing my CA, initially I thought I would be a teacher.
Okay.
I loved teaching, but somehow, stock market was my second best choice, and that's how where I am today.
But you're educating the investors as well today.
Yes.
So that's a thing. And the third question I would like to ask is that if you're going to, metaphor your fund management with a movie of today, like what would that movie be?
So I think Three Idiots would be the movie. I think it's about chasing your dreams. And, I believe that every day we are in a learning process. Even today, we feel that there's so much to learn, so much to understand. So I think Three Idiots is something which I think where a lot of new learnings was there. And I think that's one movie which I really liked about it.
Thank you. So with that, we've come to the end of the session. It's like you have given insightful information on the markets, on the products, and also a bit about yourself to understand how, Ashish is, more than a fund manager.
Thank you, Akshara. Thank you for inviting me on this show. Thank you.
For the viewers here, this interview is only for educational purposes. Any stock or sector which is taken onto the interview is not considered as a recommendation, neither from PMS Bazaar nor from JM Financials Limited.